To what extent are you changing the way you think about fiscal policy, given quantitative easing and the fact that there is so much cash coming into the economy? I just wonder how much you're thinking about having a fiscal response in response to that monetary response.
As answered Thomas before, it's not really the way that I am thinking about it. I mean, our fiscal response has been designed to respond to the crisis and its effects. The monetary policy response, I think if you put those questions to Mr. Orr, he wouldn't necessarily argue that that's what the effect of the form of QE that he's been using would be. But all of those issues, particularly in terms of how it will roll out in the housing market, are still to come.
My big concern, I guess, is just the interest rates being so low and just asset price inflation already. I mean, the housing market is staying buoyed, like share markets, all that sort of thing. And, does that worry you?
I wouldn't say it worries me. I mean, it is one of the conundrums of the situation that we find ourselves in. The housing market has held up significantly more than people forecasted it would in these circumstances. So we clearly keep an eye on asset prices, and the last thing I want is New Zealand to go through what it's been in the past with significant bubbles. So, we clearly keep an eye on that.
Minister, all of these forecasts are better in the short term, better in the short term and worse in the long term. The only exception is house prices, which are better in every respect. Is that something that you're proud of, the immunity of house price growth to, house prices are the only thing in the world that is immune to COVID-19?
There's a great deal of uncertainty around what will happen with house prices.
Bank lending for businesses has plummeted, while lending against residential property is up. Barfoot and Thompson has reported its highest number of sales for September in 5 years. House prices across the country up 7.5%. Do you accept that house price growth and the wealth effect that comes with it is actually foundational to your plan to grow the economy?
I wouldn't say it's our long-term plan for a sustainable economy, no. I mean, we do need to be, as you're pointing out, seeing more investment into businesses, seeing more investment from people at a household level as well that isn't about housing. But clearly housing is part of the economy, and as we've seen in previous cycles, we do go through periods of this period of time where we see a significant increase in the value of homes. But no, the sustainable economic growth in New Zealand is going to be about improving productivity. It's going to be about making sure that we do see in business investment grow. Business investment, in the way that you characterise it, is around confidence, I think, and we're starting to see some confidence return. And I do think we're seeing a policy mix from our side that will support investment into the productive economy. But of course, part of the result of lowering interest rates is people looking at assets like housing.
When is the last time you've been briefed by the Reserve Bank on how its actions are impacting your portfolio?
So I don't get regular briefings from the Reserve Bank. Obviously that gets worked through my officials.
Last question. On the issue of monetary policy and fiscal policy and the relationship between the two, clearly everything the Reserve Bank does, it's really pulled out all the stops with its monetary policy, the new funding for lending program, QE, everything. Why is the government not rethinking its policy settings, giving consideration to the impacts of that huge stimulus that the RBNZ's doing?
I absolutely reject any suggestion that we are doing anything other than making a huge investment and putting the weight of the government behind ensuring that our economy, through this 1 in 100 year event, not only survives but thrives. We're seeing record investment in infrastructure, over $40 billion worth, the likes of which we have not seen in decades. We've seen stimulus going in via income support payments to our lowest income workers, investments in trade and vocational training that essentially make training free for a large number of New Zealanders. We are pulling out the stops and using the levers that we have available to us. Some would argue that we should do things like tax cuts. We just happen to disagree that that's the right tool for the right time.
But what about additional measures to address the inequality specifically? Because those asset prices are going up, that the haves have more, the have-nots have less. So why is there not more of a policy response targeted to that?
And of course, some of the most significant investment we saw straight off the bat was billions of dollars to ensure people stayed in work. was investment in lifting main benefit rates, the doubling of the winter energy payment, all supporting low-income workers. But actually, I do think that we need to take into account New Zealand's relative position. Here we are with unemployment rates that relative to other countries are low, below the OECD average, below Australia. And we have the early signs of New Zealand's economy making an early recovery. So this is a 1 in 100 year event. We can't look at New Zealand in isolation and just compare it to itself. We need to look at how we're doing relative to others as well.
If you were to go back to first principles and you said, well, why would you want a capital gains tax or something akin to it? The capital income tax that Michael Cullen and his team were proposing. Though that rationale, I think, makes even more sense now than it did previously. And in part, it's to deal with this issue with stimulus money flowing through into asset prices rather than into the real economy.
So the Reserve Bank's doing quantitative easing, that's fine. But a side effect of that is that asset prices could increase. That's what's happened in other countries in the past. I'm wondering whether you think the government needs to do something to try to prevent asset prices ballooning as a result of quantitative easing?
Oh, you want asset prices to go into recession and depreciate, do you?
No.
Well, line up by yourself if that's the case. Because anybody thinking forward for this country wants to see an appreciation of our asset value at all private and public levels.
If the Reserve Bank were to create money, it could do QE for the people, in which case it just gives that to everyone equally as a form of, you could call it a UBI, you could call it helicopter money, whatever you want to call it.
Well, that is very much a risk from all the quantitative easing going on, that we are seeing asset price inflation. We have, since the global financial crisis. I think the best solution to that is not more taxes, but an absolute focus on dealing with the difficulties, particularly in the housing sector, because the biggest asset for most people in New Zealand is housing, and so reducing the cost of producing more houses is the best policy response, and that relates to the RMA and many other things that need to be done to enable that our housing sector is more efficient and produce more houses.
The Reserve Bank is obviously the influence that it's having on the economy at the moment is massive, particularly on house prices. What will ACT provide more oversight over what the Reserve Bank's doing, particularly with its monetary policy?
Well, I got great news for interest.co.nz. Monetary policy is about to become sexy again, and it's going to become a political issue, because what this Reserve Bank is doing with their unconventional monetary policy, their super low interest rates, they're printing $100 billion, it's all going into the walls of houses effectively, and that ultimately leads to social exclusion and people being very upset. So yes, we are going to have to revisit monetary policy for the first time in probably 35 years.
How would you want to do that?
Well, I think what you're going to have to do is ask, should asset prices be part of the set of targets that the Reserve Bank has?
All I'm suggesting is, if the government is clear that we do not want to see rapid escalation in house prices, the Reserve Bank is smart enough to be able to work out the best policies to implement to make sure that it doesn't continue to occur.
So that would require a change of mandate?
No, I don't necessarily believe it does require a change of mandate. What I think it could easily be achieved is the government setting a level of expectation. But that doesn't mean a change of mandate.